rate rise for nearly 20 years to try to contain the steepest inflation for 40. The US central bank had little other choice than to hike its benchmark lending rate by 0.5% to between 0.75% and 1%.
The Fed typically raises its benchmark rate used by banks and other credit providers gently to avoid making financial conditions too difficult for businesses and consumers looking for credit. But with inflation edging up towards double digits, the Fed is now being forced to act much more aggressively. And the question is, how much further and faster will it have to go to bring inflation down to its target of around 2%?
There's an increasingly pessimistic view among some economists that the Fed will have to effectively stop the economy from growing to meet that target. And an economic contraction in the first quarter of the year is for some a portent of what Deutsche Bank has called a major recession looming. But Fed Chair Jerome Powell is trying to avoid using the R word.
Inflation is much too high, and we understand the hardship it is causing, and we're moving expeditiously to bring it back down. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses.
US presidents can't do much single-handedly to control inflation, and Joe Biden was on Wednesday focused on bringing down the deficit, a perennial problem that drags on growth and has contributed to previous government shutdowns.
We're on track to cut the federal deficit by another $1.5 trillion by the end of this fiscal year. The biggest decline in a single year ever in American history.
And yet, if Biden's options are limited for curbing inflation that's at least 8.5%, the Fed's problem is that inflation is now a global crisis, with ongoing supply chain problems and the conflict in Ukraine driving prices higher everywhere. Owen Fairclough, CGTN, Washington.